We're looking at the Saeed case study on private markets. Let's scroll down and read the first question. Determine the payoff of the merger arbitrage strategy to Saeed if the merger transaction is closed successfully. Show your calculations. So when we're looking at the payoff of a merger arb strategy, we're going to be going long the target, and then we're going to be going short the acquirer. And then basically the amount that we're going long and short, the difference between that, we're going to capture that spread. So for this question, we need to figure out the two companies involved and then figure out where we're going to go long short. And then from there, we can figure out that spread. And that'll tell us what our expected payoff will be. Sana Saeed, CFA, is a portfolio manager at Alternative Investment Advisors, focusing mainly on institutional clients such as local college endowments and foundations. Saeed's primary expertise lies in merger arbitrage strategies. Recently, Saeed has been monitoring the potential acquisition of Trip & Co. by Travel International. So we've got our target here. So the Trip & Co. is going to be our target. So we'll be going long Trip & Co. shares, and then we'll be going short the acquirer, which is Travel International. Travel International is trading at $50 per share and has offered to buy Trip & Co. in a stock-for-stock deal. Trip & Co. was trading at $15 per share just before the announcement of the acquisition. The offer ratio is 1 share of Travel International in exchange for 2 shares of Trip & Co. Soon after the announcement, Trip & Co.'s share price jumped to $18. In contrast, Travel International's share price fell to $44 in anticipation of the merger receiving the required approvals and the deal closing successfully. Saeed looks to profit from the merger announcement at the current share prices of $44 for Travel and $18 for Trip. She buys 100,000 shares of Trip & Co. So we're going to be buying 100,000 times 18, and then sells short 50,000 of Travel International. So we're selling short at 44. So it even tells you what we're going long and selling short. So we just need to kind of know that we're going to be capturing the spread between those. All right, so let's pull in those calculations then. This will be pretty brief. So we're going short 50,000 shares at $44 right here for Travel, and then we're going long 100,000 at 18, and then we take the difference between those, and that would be our payoff, 400,000. Question 2. Determine the payoff of the merger arb strategy to Saeed if the merger transaction fails. Show your calculations. So we've already read down to here, so we should have all the information we need. So basically, to calculate what happens if we fail, we're assuming that the share prices will go back to how they were. So as you remember from the last question, and I guess it tells you right here, so we're long 100,000 shares of TripCo at $18. If the merger fails, we're going to assume that that goes back to $15 per share. So we're going to lose, 300,000 on that side of the trade, and then we're going short 50,000 at $44, but we would assume that the share price goes back to 50 if the merger fails. So we're going to lose that $6 spread times 50,000, so another 300,000. So let's just pull in those calculations there. So we see for our short, we're going to lose 300,000 because we're going to lose $6 per share, 50,000 shares. Long, we'll lose $3 per share at 100,000 per share. So our total payoff is negative 600,000. Question 3. Describe how each of the following circumstances can create concerns for Khan's proposed convertible bond arbitrage hedge fund strategy. All right, let's start reading a little bit more since we haven't heard anything about this yet. So we left off here. Ali Khan is the Chief Investment Officer of Near Future Foundation. Khan has reached out to alternative investment advisors to explore additional investment in alternative strategies. Although the foundation has significant exposure to alternative investments in hedge funds, Khan would like to increase exposure to relative hedge fund strategies. As part of Khan's due diligence on a hedge fund engaging in convertible bond arbitrage, Khan has reached out to Saeed to understand the different risks associated with the strategy. Khan is particularly concerned about adding investments with relatively high liquidity and low risk. After helping Khan understand the different risks associated with convertible bond. Okay, so we've got the information we need, and there's really not too much in the paragraph that we need here. It's more so just kind of what are the risks of convertible bond arbitrage strategies related to short selling and related to credit issues. So as a reminder, on a convertible bond arb strategy, essentially we're going to be going short the underlying stock, and then we're going to be taking those borrowed funds and then using that to buy the convertible bond of that same stock. So let's pull in our answer here, and we can talk about these two different types of risks. So short selling, like we said, the manager is going to be shorting the underlying stock for the convertible bond arb. Something that could go wrong here is if we get a short squeeze at a bad time. This could lead to astronomical or hugely increased borrowing costs, making the trade kind of less profitable or unprofitable. And then on the credit side, convertible bonds do have credit risk. They're going to have some spread over treasuries for their credit risk. So if those spreads widen greatly due to some market dislocation, this could lead to a mismatch in the arb opportunity between the convertible bond and the stock. So essentially what these two are kind of getting at is if something extreme happens where there's kind of this big market dislocation, it kind of could cause one side of the trade to divert from the fundamentals, and then you're not able to kind of capture that arbitrage spread. Question number 4. Determine which of the two benefits mentioned by Saeed to support the use of merger arbitrage strategy for a near future foundation is most likely correct, and justify your response. So we've got benefit 1 and benefit 2. Looks like we've got those right here, but let's read everything down to there. So we left off right here. After helping Khan understand the different risks in the convertible bond arbitrage strategy, Saeed proposes Khan to also consider investing in merger arbitrage strategies as it offers two major benefits. All right, let's determine which of these two is correct. Benefit 1, merger arbitrage strategy would offer relatively high risk-adjusted returns without compromising much on liquidity. That sounds like it's correct. Merger arbitrage does typically offer pretty steady returns, and those steady returns come with pretty low volatility. So those steady returns combined with low volatility typically leads to a pretty high Sharpe ratio, which would indicate high risk-adjusted returns. And then for the liquidity point, we're typically doing this on publicly traded stocks, which are generally going to be quite liquid. So benefit 1 sounds like it's correct. Let's make sure benefit 2 is incorrect. Focus on cross-border M&A is low risk as it provides significant diversification benefits due to the acquirer and target being in two different countries. So that's going to be incorrect. Cross-border M&A is going to be higher risk because there's multiple jurisdictions or governing bodies involved, so that just kind of adds to the complexity in the amount of rules in play there. So here's the answer. Basically kind of gives what I just said in bullet point form, but there you have it.